Happy eclipse. We had an eclipse yesterday. I made a sacrifice. Not a human sacrifice, but I made a sacrifice. And then today the market gods rewarded us. So let's go ahead and take a look and see what happened. Hey everybody, it is Pookie's Revenge. We are back with another episode of the $500 5-year Rags to Riches series episodes. So yeah, we had the eclipse yesterday. It was pretty cool. The unfortunate part is I live in New York, upstate New York, and we had clouds. We got to maybe 95 out of the 97%, and about 2 minutes before the eclipse was supposed to peak, we had clouds just roll in heavy and thick, and we couldn't see anything. So, but that didn't stop us. Right, it just got cold and dark for a few minutes, and then it brightened back up a little while later. But we had a good time. It was fun. Now, during the eclipse, I may or may not have sacrificed to the blood gods of the market. I left just a single contract, mostly so I could make this episode. I left a single contract on SPX, so I lost a little bit of money on it. I just let it die. Kind of kicked it down the stairs, if you will. So let's go ahead and take a look and see what happened today. This is the portfolio, and this is the result. So this is an anomaly, so I don't want people to think that, this is what's going to be happening every day in the market. So let me just get this particular thing out of the way, and I'll walk you through what actually happened. So I don't want to, again, managing expectations is what makes you a successful trader, and expectations are tied directly to risk. So first off, the account has pulled down a little bit, right? It's not over 7K anymore. And that's just because most of it was, well, not most of it, a good portion of it was NEO pushing up. So NEO had a nice, beautiful day. They had a catalyst and just pushed all the way up to almost $5. So it cleared over the recent high. We had a nice little retrace on it, and then it pushed back up into close. So I'm pretty confident that that should, in theory, right, continue to push up. We may see a trend reversal here, but there's no guarantee. So with that said, let me just pop the RSI on here just so we can see we got some mild divergence here. It's nothing crazy. If I kick it up to maybe the daily, we could probably see it a little more pronounced. And it looks like a little bit. So it technically qualifies, but it's not quite as strong as we'd like to see. So just going to let it keep going, let it do its thing. I'm not going to try to force this up or down. I'm just going to be focused on using these covered calls. Remember, we got the $5 covered calls in addition to all the ones that we've already collected profits on. So I'm going to see where this goes. Plug had a decent day, kind of popped up, did a retrace, popped up again, failed to push over the new high, fell back down right to retrace territory, and then it just kind of went back up a little bit, right? So it's nothing crazy, especially considering we had two massive days of sell-off on the 4th and the 5th, and then before that we had pretty massive, and by massive I mean it's a little bit. I'm just zoomed in really far on the 2nd. So not a good start for April, but it's okay, right? This is one that we kind of want it to go mild to bearish because we want to sell those covered calls repeatedly on it and collect all these delicious premiums and harvest that theta as much as we can. Then there's WBA. Now on April 4th, I did get assigned and I got those extra 100 shares and I sold another covered call. So that allows me to essentially double my profits on these covered calls. And I really, 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 really like it when the price does stuff like this. It just goes kind of sideways. Because that allows us to maximize those covered calls and just collect as much theta as possible because the buyers of those contracts are watching their contracts die, where we're just getting the money. So, so far, I sold this at $5. Nothing crazy. I sold it pretty high for what it was. I didn't want to go too far out on the expiration date, and the reason for that is the theta per day ratio. So I'm just going to keep selling these little short expiration ones, and we'll see where it goes. SPCE, same thing. Just had some sell-off into April, and we're just selling covered calls against them. These ones are much better premium, but I also sold a cash secured put against these. So as the price goes down, the value of the put goes up, right? So if it goes below $1, I may or may not be assigned. Otherwise, the put should expire as October approaches. Now, I kind of want to get filled at $1 because I have my original shares at $1.41, so I don't mind averaging down. And I still have plenty of cash on the side, obviously, but I don't mind averaging down. And in order to average down, I want to use a cash secured put because it's better than just placing a blind $1 buy order when I can get paid to place that same order and additionally reduce that cost basis even farther. Okay, so easy enough concept, but the downside here is that this contract's good till October. Okay, so if price shoots all the way back up, this contract may die off, at which point I could just buy it back to close it, open a higher one. Otherwise, if the price goes down, this contract will die off as it is, and then I'll get more and more premium from this. This one may or may not get filled, at which point I just buy shares where I want to buy them anyway. And then the overall average on the shares goes down because I'm buying far enough down where it's going to drag my average down to like the 120 range, and then I can just repeat the process. But that's not what this episode's about. This episode is about SPX. So yesterday, like I said, I had a little bit of a sacrifice moment. And I can't remember exactly what it was. I think it was a put. I don't remember. It was somewhere around here when the market was relatively flat. And the reason for that, I didn't expect it to die, but I didn't expect it to go anywhere. The reason for that is just the price is going flat. So as a buyer of the contract, theta, especially on 0 days, especially on SPX, it just kills them. So the contracts just deflate really fast, and I just kind of wanted to have a little bit of a gimmick for this episode, and I didn't mind the extra contract dying because, I'm okay with it, right? Then, of course, we had the massive sell-off this morning. We have CPI coming tomorrow also, which means I'll be able to trade tomorrow morning and get pretty good scoops. But I do have to take some time off tomorrow. I have some personal things I have to attend to, so I won't be around for the whole day. But I did not trade this sell-off. Instead, what I was trading this morning was LASE on the 1 minute time frame. During, I think I grabbed like this area. I want to say it was this, and it was just little pops. It wasn't anything crazy. And then ACRV was kind of the bigger moneymaker for the day as far as the equity side goes. And that was just trading these little pops and pullbacks. I traded quite a few of those. And then MDIA, of course, is Old Faithful here. So we had a trend line drawn. We kind of knew not to violate that. So once that sold off, I was just looking for a little pullback. So I grabbed a little bounce around here. And I sold it pretty quick, right? I didn't want to get caught in this if it was going to go H-shape. And fortunately, it just formed higher lows, but I wasn't in it very long. So most of the cash here came from SPX, and I'll show you kind of what that looks like. So we had that initial sell-off in the morning, right? Hard sell-off. And on the weekly watch list that I put out, we kind of knew it was going to test the 5150 level-ish, somewhere around there. So we saw it pull back up with a nice bullish engulfing at 5160.78, but I didn't trade it then because I was trading the other stuff. I try to trade SPX after I trade the more secure stuff in market open, just so that I can catch the volatility without putting SPX risk up front. I'd rather just trade with the profits. That way I know at least I'm secure for the day, and I can always just back off if I want to. All right. So it went up pretty consistently, and then it kind of headed into this little retrace here. All right. So we got the bearish impulse and then the retrace, but it didn't sell off hard. I was expecting a much harder sell-off to challenge this new low. It should have, right? We got CPI coming out tomorrow, and it was quote-unquote leaked. But if you look at the daily chart here, we're in a strong bullish uptrend. So I was pretty confident in a bullish trade for this instance, but I wanted to keep the stop relatively tight for what it is. Obviously, I'm zoomed very far in here, but I didn't want it to violate this kind of up and down here. So impulse, retrace, and then again right here we didn't see that bearish continuation, and we also violated the the head and shoulder setup that we saw on the 5 minute. So we look on the 5 minute here. This thing should have sold off pretty nasty, and it didn't. Instead, we ended up breaking that shoulder, and the price went higher. And then obviously we got a pretty nasty little sell off here. I'm sorry, this was this morning. I apologize. This was the sell-off I was looking at. Sell-off, retrace, and then it kind of just curled down. But the head and shoulders here, I believe it was right here. I was looking at, let me just kick back down to the 1 minute. Sorry about that. It likes to shift around on me. I think I was looking at this as the head and shoulder. We ended up breaking that, and then we had another setup right here. Right here, which should have broken to the downside, but this didn't go up any higher. Instead, it went down, and that should have led to a massive sell-off, but it didn't. So again, I was pretty confident in the previous low holding from yesterday. And what ended up happening was at the end of the day, we tend to see these pumps. So we got nice, clean, bullish engulfs on good volume. And by volume, I just mean that I was watching the candle in the moment. You can't actually see the volume on SPX. But I was able to watch the participation of the candle, and I could kind of get a sense for the volume that way. I saw a lot of fluttering and a lot of flickers and a lot of the, I like to call it AFib. It's a specific behavioral pattern on the candles. And again, if this is like too advanced, if you don't want to speculate too much, you could just not do this part, right? It's okay, right? That's the advantage of this series, is that you're taught all different approaches. So speculation alone shouldn't make or break anybody. But what this allowed us to do is it allowed us to capture the majority of this impulse right here. And if you look, every single one of these candles until this guy right here has a higher low. And what that means is once we see 5 or more, so 1, 2, 3, 4, 5 candles. So this guy right here, let me just make that nice and fat. Once this candle forms, that tells us that 1, 2, 3, 4, 5 candles in a row have higher lows. So the low of each candle is higher than the low of the candle before it. And at that point, you can move your stop loss up immediately below that candle. And then the next candle forms and closes. You move your stop loss up there, to the next one, to the next one, to the next one, to the next one, all the way on until we get to right here. And then this guy right here, okay, he violates that rule. He violates the 5 candle rule. So this right here was the entire technical bullish impulse. It's not going to let me draw my, well, let me snap it down here. I'll just do it to the bottom of this candle, but you guys can identify that right there. So, we got a good 0.5% or $25 worth of price action on SPX, which translates really, really well into contracts. Now this pullback, this little shallow retrace here, and then continuation, I did not get into. I didn't stay into it. And the reason for that is because what we're not going to do after having a big win like this, when you're up 7K for the day, you're not going to sit at the table too long and give those profits back, because that is exactly what most traders do. And that's where most traders end up failing themselves. So I earned those profits and I wanted to keep those profits. And that will allow me to start tomorrow with those profits in my portfolio. If I gave them back because I wanted to be greedy, I wouldn't have them. I would have a loss, or a profit that I have to pay taxes on, as well as a loss. So don't do that to yourself. If you're a new trader and you make a good profit, it's always okay to just walk away, even if it's a small profit. If you just make like maybe 3% on a trade and you don't want to risk it, like maybe that 3% might impact you. Like if you start to identify that you're feeling something about that trade, or that you could do it again, that's a gambler's fallacy. Expecting the same outcome just because you did it already, that's a faulty logic, and it'll hurt you. And that's what the market relies on. There's a saying, Vegas wasn't built by the winners, and that's true. It's all the money that they get from people that win a bunch of money, and then they just give it all back plus what they walked in with. And you don't want to do that, because that's it's counterproductive for the purpose for why you're starting this. Like if you're watching this episode right now, you're watching it because you want to take this seriously, you want to learn, you want to break the cycle of what you've probably been doing, and that's probably, buy up here and then watch the price go all the way down, and then you're like, oh, it's going to come back, but you can't really articulate why. And the reason for that is because you're conditioned by just being a human, and our default, our neurophysiological makeup basically tells us to do certain things without us realizing it. And your brain can't always recognize that stuff. Your conscious brain, like the part that you're thinking about right now, and that little voice inside your head, like you might not recognize, what this particular setup means, or why it's risky, right? You might just jump in because you see this part, you're focused on this, and the price is going up, and you say, oh, okay, all right. So it pulls back a little bit, you see a little bit of green, you might jump in here, right? Which is fine. You can always take that risk, and you can always look for continuation and stuff, and little shallow pullbacks. But the brain by default tends to ignore this, and that's where people get hurt. It's not this, okay? We see a strong impulse, we see a shallow retrace, we see green, right? Even though it didn't retake the red here, which is fine, right? You don't necessarily need that specific approach. But if you see something that you can justify, and it's something mechanical that you can follow, and you can do it consistently, that's great. I absolutely encourage that, as long as you're safe. And the problem, again, isn't that. That's not the issue, right? It's this part. It's the part that allows us to compromise our rules and allows us to deviate from our plans. So my plan for this trade was on the higher time frame. So I'm okay holding it as it retraces, fails to continue to the downside. It didn't go H-shape, and it popped back up into close. That's part of the approach that I took with this trade. If it broke this low, I wouldn't be in that trade, because I know that at that point I'm just losing money for no reason, because I can't justify the original trade that I entered. So, the fact that this popped, it's great. It's not, I don't really necessarily chalk it up to luck as just part of the higher time frame. I'm glad it did it today. But I'm not going to put myself in a position where something like that is going to make me lose 90% of my portfolio because I don't know any better, and I don't want to just risk everything, you know? So I see that a lot. I see it all the time when it comes to people winning. It's not so much the red days you got to worry about, it's the green ones, because that's when you lose your profits and extra, right? It's not so much you're trading with house money, so you don't take it so seriously, but you end up mixing your own money in with it too because you want to get back to where you were, right? You're like, oh, I had such a good day. I'm $2,000 up, or I'm 10% up on the portfolio. I want to get back up there so I can at least, have the same good day I was having as I was before. Problem is, that's not going to happen. 90% of the time, you're going to lose, and you're just going to lose more than you were. So you're not just going to watch a green trade turn red, you're going to watch a green day turn red. And that's demoralizing. It's frustrating. It's stressful. And that's when impulse comes out, makes us do dumb things. And when I say do dumb things, I'm not calling you dumb. It's just the default dumb human behavior that our brains are pre-programmed to do. Those actions come out when we take that wall down that protects us. So a couple things we can learn from this, right? First, when you're having a good day, be aware of yourself. Always do those self-awareness checks. Make sure that you're not letting those hormones, the adrenaline, the endorphins, make sure that's not running too high. You don't want to ride the high and give all your money back. Don't sit at the table too long. Another thing, your max risk. If you don't want to risk more than 2 candles worth of range, you don't have to. And that's something I see a lot of people kind of struggle with when it comes to, let me just erase all these and I'll show you what I mean. So when it comes to looking at trades and consistently executing, right? There's no difference between these 2 candles right here, these 2 candles, and let's pick a good one here. I don't really see anywhere where there's an engulf. That leads to a loss here. Let's say we got this guy right here. Okay, these 3 candles. All right, so it's kind of hard to do. Well, no, you know what? Let's use these guys. This is a good example right here. Okay, so all 3 of these are relatively similar in that they are a small red candle, a green candle, right? This is an engulf, therefore the entry can most of the time be safely assumed to be here. And you've got a defined risk, and then you've got some sort of defined take profit up here, or you can use something like the 5 candle rule and just let the price go appropriately, and then move your stops up. But all 3 of these are exactly the same in terms of stock market and opportunity. Okay, they're all the same setup. It's just a small bullish engulf. The only thing that our brain recognizes as different is the fact that what occurs after them is different, right? So this trade, it's the same as far as profit potential goes, right? Like we would have entered on the break here, we would have a defined risk right here, and the trade would be up here, right? This would be a win. All right, same thing here. We'd have a nice defined risk right here, and this would be the outcome, some potential in there, right? Whether or not we take profit is a separate issue, but I'm talking about just the entry, okay? And then this one right here, okay, we would have entered, and then our target might have been a little higher here, so maybe we would have taken a loss on that one, right? So this is the end result that our brain focuses on, okay? The problem is that this trade right here is going to impact your ability to enter consistently on trades like this. And that's going to cause you to be inconsistent, and that inconsistency is what tears you apart. So as far as the market's concerned, those candles are exactly the same. And as far as you're concerned, those candles should be exactly the same as far as managing risk, right? Our job, again, isn't to predict. It's not to try to be right all the time. Your job is to manage your risk. So in this case, if we're looking at these in terms of risk, okay, I'm going to have to draw these. Well, let me turn this magnet off so I can actually draw them accurately. Okay, in terms of risk, all right, if I zoom in here, right, this one here, maybe use the wick rule, maybe you don't, you might have stopped out, you might not have, either way. If we use like just a 1 to 5, right, let's get crazy with it. Okay, your risk on this trade would have been 85 cents or 0.02%. Okay, and again, it's a little different with options and all that good stuff, but it's the same concept, right? Your risk is much smaller than your profit potential, and in this case, again, maybe you stopped out, maybe you didn't. Right? I personally just use the wick rule for most of these. And then let's just consolidate that back down, make it nice and small. And then if we look at this one, okay, same thing. Okay, there's your profit potential right here. Or I'm sorry, your risk right here, okay? And then just, again, a 1 to 5, just for the sake of being crazy, right? You hit your take profit right here. So your risk was 53 cents, your dollar profit potential was $2.65. So you got a 1 to 5 risk reward ratio. In this case, that was a clean win. right? Very easy to identify. And then where was the other one? Right here, I think. Let's use this one. Let's use all the engulfs. All right. Okay. There's your risk, and let's do a 1 to 5. Just again, just for fun, right? We don't always want to use a 1 to 5 risk reward. 1 to 4.98, it's fine. So in this case, the risk is $1.47. The profit potential is $7.32. Okay. As far as the market's concerned, these trades are exactly the same. The only difference here is the size of the risk and the outcome, right? And that's where our brain gets in our way. Okay. So in this case, this is a nice tight risk. Okay. You may or may not have stopped out. It's irrelevant. Okay. You're going to walk away with either a profit or a loss at the end of the day. And in this case, it would have been either one, right? It depends on how you approach the stop loss, whether you put a hard stop in place or not. This one, clearly defined winner. Okay. Maybe you locked most of your profit here, allowed the pullback above your stop loss. Maybe you put your stop loss up here above your higher low, like you got a higher low here, and then maybe it didn't quite get to the 5 candle rule. Maybe you watched it come all the way back down and hit stop loss, right? Either way, it doesn't matter. Okay. That's still a guaranteed net profit as long as you follow a few simple rules on this trade. Okay. There's nothing disputable about this trade. This one there is, because the stop loss may or may not have been exercised. This one, same thing, undisputed loss. Okay. You would have entered, you would have had a defined risk, you would have had a defined loss. Okay. It just would have been a loss. There's no way you could have gotten out of this unless you would have compromised your stop loss, blah, 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 blah. But as you can see, that ain't always your best friend, because it goes low, it comes up, it goes low, and then it just goes lower, lower, lower. Maybe it comes back up, maybe it doesn't. If you're on this time frame, it's probably better just to take that small loss right there in the moment. And that's all I did this morning on the equity ones, like LASE, ACRV, and MDIA. I just put a 3% stop loss for all of them, 3% or less, and a 10% minimum profit. Okay, and most of the time I ended up deleting those take profit orders because I wanted to just let the price breathe. So if you don't know how to do that, that's okay. What I'm trying to explain here is that you can pick any 2 candles at any time if this is something you prefer to do. Just pick any 2 candles, and the risk of the red candle essentially is going to be the size of your risk. So if we're looking at these candles right here, for example, or let's pick one that's not on let's pick one that's not a bottom, right? Because we don't want to use blind data here, okay? And we don't want confirmation bias getting in the way. So let's say you're waiting for a color change. Let's say this. Let me just erase this. Let's say that you got this retrace here, and you're looking for a break. Okay, you want it to break over these levels. Let's say you don't even know anything about that stuff. Let's just say you're just trading red and green candles, and you don't care about anything else. Okay. If you were to look at, let's say this one, for example, even. All right, you've got a bullish engulfing candle right here. All right. This risk, the lower of either of these 2 candles, is your risk range. Okay, so if you entered on a break over the open of this candle, the red candle before it, okay, so the open on this one is 5190.16. Okay, right where the top of this red body is, your risk can always be the lower of either of any 2 candles, right, or even the candle itself. You don't necessarily need to expand that risk range anymore, because what you're going to do from a logical perspective is, if the price goes up, you're going to let it breathe. And if the price goes down, you're going to choke it, okay? Because you don't want the price to go down. You want it to go up. This is one of the fundamental misconceptions about the stock market. You don't need to let everything breathe to the downside. There's definitely a time and a place to do it. Let's say you want to get into an investment, or maybe you see a higher time frame setup. Absolutely. In that case, as long as you have a strategy for it. But if you're just trying to catch momentum, and you're just trying to catch things that are moving, or if you just don't have a high risk tolerance, why would you let things breathe to the downside and then throw more money at it if that's not part of your original plan? If your original plan is to get in on something like an engulfing pattern where you want it to just go up immediately and not come back down, do that, and your life will be a lot easier. This is the approach. If your plan is to catch an engulfing pattern, that's a sign of strength. You don't want weakness to follow, okay? Because that's what's going to cause you to lose. And if you're going to lose, your job is to control that loss. It's to control the risk and to manage it. And that's what people don't do. And that's how they hurt themselves. So we can fix that. So in this case, you would have had a defined loss. Okay, it's easy. It happens. You don't control the outcome. You only control the size of this little red box right here and the size of this green box. Okay, and you pick which candle you get in on. You could literally just flip a coin if you wanted to. And you could just use that same approach where you're just using the lower of any of the 2 candles for a stop loss and some predefined greater than 1-to-1 risk reward for a take profit. Flip a coin 100 times in a row, you're going to do better than 90% of the market anyway. So as long as you don't interfere with that process and you're not giving the profits back and you're not letting the price fall off, like right here, okay? If this was your threshold for entry and you're someone who's trading the bullish engulfing strategy, this would be your loss level right here, the lower of these two candles, or the lower of these three, I guess, because you'd want to combine them. Let me just do that. Okay. If that's your threshold for risk and your take profit is somewhere up here, that's a great setup. You don't control this. You don't control where it actually goes, right? You know it's going to go up or down. Ideally, you want it to go up, but you don't control that. You only control how far down it goes while you're still in it. And likewise to the upside, okay? So what I'm trying to say here is that if you're someone who's just constantly losing on speculation and you're running into that wall of you'll never figure it out, or your losses always wipe out your profits and all that good stuff, and you figured out everything else, you've got your appropriate position sizes, you're not over allocating into things, you know, you still can't figure it out, but you're still taking big losses. That's the problem. You can fix that. That's a very easy problem to fix. Just practice. Just pick two candles, just randomly 2 candles. Okay. Ideally, you want the second candle to be going up because that's the direction you want to trade it in, right? So if you were to pick like these candles, for example, all right, and what we can also do is we can add another filter to this, and this is something I discussed earlier on. If this range here is too big, like let's say your max range on like something like SPY, for example, you only ever want it to be 20 cents or less, you wouldn't take a 25-cent risk in that case, right? So in this case, if we're looking at SPX, which is much bigger, much scarier, and much more volatile, let's say you wanted to keep your losses or your risk limited to maybe $2, okay? This range right here is $2.62, so we can automatically ignore it, that opportunity, okay? And it doesn't matter if the price goes all the way up like this. It doesn't matter because the risk wasn't worth it, and this right here is that hindsight that'll mess you up 90% of the time. It happened to have worked out in this case, right? But how consistent is that? How often are you going to be rewarded for taking unhealthy risk? Whereas, how protected are you going to be if you consistently manage your risks? Okay, that's far more important than just being rewarded. So, if you're struggling, I don't want you guys to be, you know, taking all kinds of crazy risks for no reason. So, just practice. Spend an hour. Just take an hour out of your life and just practice. All right, draw yourself a box if it helps. In this case, I said $2. So let's just draw a $2 box, or as close as I can get to it. Okay, $2. And now this box becomes my safety bracket. Okay, so if I see like this, for example, and I'm looking for a break over this red candle right here, and I want the low to be in that box, this fits. So instead of taking this entry right here with this kind of risk, okay, I could just wait till the price is in a more safe zone and still get the same entry, basically, and have a tighter risk. So same entry, smaller risk, I'll take it. All right, and then same right here. If I'm looking for a break over this level, the lower of these two candles is in this box or above it, or above the bottom of the box. So therefore, this is a valid entry opportunity, and I could practice taking this for win or for a loss. This right here, I got to move it over. Ignore this candle. I just have to move the box over so you can see this guy because it's a doji. The low of this candle and the low of this candle are inside this box, or at least above the low of the box, which means this is a valid entry opportunity, okay, for win or for loss. Same here, right? In this case, your stop loss would be right here, not the bottom of the box all the time. You don't always want to have a $2 loss, but your stop loss. What am I doing here? I had my hand on the other side of the keyboard. This would be your risk range right here, just this little block right here, okay? So maybe you take a loss on it. Now, again, for options, it's going to be a little bit more extreme because you're dealing with percentages and contracts, which represent 100 shares. So the P&L will be a little bit bigger. But if you're just looking to get some logic behind your trading, like right here, for example, you know, in this case, you're looking for a color change. And at one point, this was a green candle because it has a wick, right? It just happened to close to the downside. Your risk range would have been the lower of any of these candles, anything within that box. So in this case, this red here is the establishing candle for the threshold. So you want the price to reconquer this zone, basically, and it does right here. All right, that's all I'm getting at with this. So does this fit within there? Absolutely. So you would have taken an entry here. Your stop loss would have been right here, right? And this would have been your trade. and then your take profit would be up here somewhere. Now, in this case, it was also a loss, and that's what matters. Here is the understanding that it doesn't matter, okay? So again, if I look at the next opportunity, I got a red candle right here, okay? Stop loss goes right here. Entry is here. Take profit somewhere up here. You make that back and then some, right? You know your loss will never be greater than $2 in range if you approach the market like this. And you can make this as big as or as small as you want. If you make it super small, the only drawback is you're going to have fewer trade opportunities, right? Because there's less stuff that'll fit in there that matches that. So like this one, for example, would. Easy fit. Let's see here. This one would not. This one would, right? So you can, right? You can make it as small as you want, but that's just going to reduce the number of trades that you get into, and that's okay, right? So the key takeaways here, because this is about a half hour long, and I apologize for that, but I want to show you guys that the trading doesn't need to be super complicated. It doesn't need to be problematically technical. Like, you can literally just pick two candles, okay? Any two candles, so using any strategy you want. If you want to use the let's say 5, 8, 13 EMAs, right? Let's just enable that really quick. 5, 8, 13. Let's say you want to use the cross-up candle, okay? 5, 8, 13. So basically that strategy just means that every time the 5, the 8, and the 13 EMAs are lined up in an appropriate way, where they're stacked bullish, meaning that the 5 is on the bottom, 13's on bottom, 5 is on top. It just shows rapid acceleration within a trend, specifically as a reversal. So let me just color code these real quick, and I'll just show you guys what I mean. So in this case, right, think of it like a stoplight, but upside down. You want the green on top, red on bottom, yellow in the middle. This right here would be the entry candle, okay? So that's your entry candle in this cross-up scenario, and this would be the risk range, okay? So this would be your threshold, and this is greater than $2, so I could pass on this one, right? I don't need to trade that. It's greater than $2, therefore I can pass on it. All right, and then we've got, that just stays in that same state, and you can pick any two candles within this, and it's still the same concept. It doesn't really matter. It's just telling you which candle to get in on based on the likelihood of it being bullish, right? So in this case, we've got this candle right here, okay? So that would be your entry. That would be your threshold. I'm just picking the entry candle itself and the one before it, okay? That's all I'm doing here. So if I draw a $2 box, roughly $2, okay? Let's see, does it fit? No, it doesn't fit, so we can pass on that one as well, okay? So in this case, you're getting a little bit of acceleration. That's okay. It's better to follow the system in this case. So right here, I mean, that's, yeah, so I guess the yellow, no, it comes within 3 cents. Oh, no, it does. Yeah, I'm sorry. It does cross up. So this one here, obviously we could just eyeball and say that's too big, right? Or maybe you grab the engulfing after. It doesn't really matter. Let's grab this fella right here. So 1, 2, 3. This right here would be the first candle. Obviously that's too big. That's, oh no, I'm sorry, that would fit. I apologize. I'm just zoomed in too far. So this would be the entry right here, and then the risk range, right? Because this is your entry candle, and that's the one before it. This defines your risk. So in this case, you'd have $1.64 worth of risk range. So this would be a successful entry. And then you'd have a take profit somewhere up here, right? Now in this case, you've got an opportunity to use the 5 candle rule. So you've got 1, 2, 3, 4, 5 candles in a row with higher lows. Okay, so you could lock 75% of that portfolio or 75% of that position at a some predetermined risk reward ratio, like a 1 to 2 or a 1 to 3. And then the remaining 25%, you have the 5% rule in place. So at this point, you've got 1, 2, 3, 4, 5, and then 6 candles with higher lows, 7 candles with higher lows, and then right here it cancels it. It violates the rule, so you'd exit the position completely. Easy trade, right? And we didn't have to do anything crazy. We're just looking at a couple lines and some colors. So right here, this one right here is the first candle, which fits our schema here, right? It's got to have the 5, 8, 13 stacked, and I'm not doing anything crazy. This isn't what I use today. You can do any indicator. I'm just showing you guys that no matter what strategy you use, you can control your risk at all times. So in this case, we would have $2.47, so we can skip this one, right? We don't need to worry about all that risk. Same thing here. This is too big, right? So we can cancel that. Let's see if we can get a clean one here. There's one. Right, so this would be perfect, okay? Another good demonstration here. Let me just get rid of that drawing. I'll get rid of all these drawings. I hate the drawings. Do them for you guys. So in this case right here, this candle was stacked bullish. It's got 5, 8, 13 in the right order. And then you've got your defined risk, and then your defined profit potential. Maybe is 1.5, whatever your approach is. If it's a 1 to 2 and it doesn't get hit, that's okay. You still just have a stop loss, and you know for a fact that stop loss is going to be less than $2 in range. Okay, and that's, again, that's what matters here. It's not about how big the profit will be or how frequently you're going to be hitting profits. It's how consistently you can make those losses small. Okay, and that's where people get hurt. They mess themselves up. So this one here is too big, so we'd skip that one. All right. So again, you can see since we're using the 5-8-13 cross up, we're getting fewer signals here on the 1 minute, but they're quality. Now this is 242. It's too big, so we can skip that. There we go. This looks beautiful. So right here is the first candle we get with a 5-8-13 cross up. And then we've got our risk reward here. Looks like we've got a $2.48. So that's too big, right? So we can skip it. And what's going to mess us up mentally is seeing this, right? We're going to see this and we're like, oh, $2 is too tight. Look at all these opportunities I'm missing. And that is bad. That will hurt you. You know, if your risk tolerance is only ever going to be $2 worth of risk range and you're trading something that violates that, you're going to be stressed and it's going to mess you up. And this trade could have just as easily gone against you, just like all these other ones. Well, the ones that fit and fell down, right? Some are winners, some are losers. Either way, this impulse could have been just as big to the downside. And if you would have taken your risk here, just because you wanted to potentially get another one of these, right? Because you thought it was going to work, you would have taken your risk range that was initially very small, right? $2. Right? And just for the fun of it, because you had FOMO and you wanted to miss out, or you felt like you were missing out, you've taken that risk range and you've made it bigger for no reason. Okay? So I'm not saying you're going to lose on this whole drawdown right here, because you'd still have your stop loss in place. But this extra piece right here, this little gap right there, that's added to your loss that you already took, that's called FOMO tax. So we don't want to pay for that. So in this case, it's okay. Just let it pass you by. In the moment, you would have had no idea what was going to happen to that price, right? You would have seen this, and you would have said, oh, that's cool. Maybe it's a little overdrawn. Maybe it's not. Either way, it doesn't fit my plan, so I can pass on it. And then what's going to happen is you're going to see all this, and then the emotions come in. Then the hindsight kicks in. It's like, oh, you're an idiot. You should have taken that trade. What are you doing? And that just happens, right? It's part of being human. That's what the market wants you to do, because then what's going to happen is the next time you see something that has a risk like this, for example, you're going to be like, oh man, it's going to be another huge profit, even though you're almost doubling, you're increasing your stop loss range by 80% for this, and it's going to reward you again. Maybe it won't. Maybe it'll punish you harder. Maybe you just take that extra FOMO tax. So in this case, that is $2 worth of risk right there. Okay, and you're unnecessarily expanding it by this much just because of maybe 1 or 2 trades. And what your brain does is it ignores the other 80% of the time when this doesn't happen. Okay, so this is just as much psychology as anything else. This is confirmation bias. Okay, this happens to mess with us. All right, and the better you can get about just following your plan consistently and not letting things like this influence you, right? Because remember, this doesn't happen until after the fact. So after you've made the decision to obey or dismiss your risk tolerance limit, this happens or it won't happen, right? Again, you don't control that. So if you're getting into trades based on stuff like this, that is bad. It's unhealthy. Don't do that to yourself. If you're getting into trades because they fit your trading strategy and they make sense and you can justify it and you've got a nice, clean, defined risk, like all the other trades we looked at, that's perfect. That's what you want to do. So if you wanted to trade the same thing, right? This is, let's just take a look at this one just for fun, right? And I really do have to end this stream here because it's almost 40 minutes, or this recording. So this is your entry threshold. Stop loss is down here. It's $1.99. Maybe it fits, maybe it doesn't. Maybe you take the trade, maybe you don't. I had no idea. Either way, it's a bullish engulfing and it's just under $2, so we could have, right? Whereas something like this, right, doesn't fit. Okay, it doesn't fit in our box. Let me just draw this out here. Right, there you go. So that's a $3 risk, okay? And as we can see, you know, as that candle's forming and as it closes, You know, we maybe enter it, maybe we don't, but it doesn't fit our plan already. So this candle is confirmation bias, the first form, right? Now, if tomorrow CPI happens and we get a beautiful, crazy response in the market, we can't beat ourselves up and say, oh, I knew I should have gotten into that, blah, 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 because the stock market can just as easily go down tomorrow real hard. And then what we're not going to do, most traders don't do, is they don't pat themselves on the back and say, man, I avoided that because I followed my plan and I was consistent. I did all the things that I was supposed to do because it made sense to me at the time. And we know that we don't need to jump into an SPX trade overnight into CPI just because that's FOMO. Okay? So this trade, yes. This trade, no. If that's your plan, right? Now, obviously, $2 is a very personal risk tolerance threshold. It's going to, obviously, if it's bigger, it's going to increase your frequency of trades and frequency of losses, obviously. If it's smaller, it's going to reduce your number of trades, but increase your profitability overall. You're just going to have slower trading process because you're going to get fewer entries, but you're going to be more confident in your trades. Like something like this, for example, super small, right? There's no reason for anybody to really jump into anything much bigger when you've got opportunities like this, right? So this is a super tiny risk. It's it's 0.02% or $1.26, and obviously all this upside potential happens. So this makes sense within our plan. So you can still get moves like this. So you don't need to feel that pressure of I need to be in all these trades in case they blast, because you're still going to get those opportunities. It's just a matter of picking the right entries and avoiding the ones that are unhealthy. So in this case, you know, we've got a setup like this, okay, at the bottom. And again, I'm just looking at color changes right now. This is my personal preference. I like to trade these. You know, this one here is 71 cents risk. That's less than half of the $2 risk that I normally like on SPX. This one here is $1.26. That's 74 cents less than the $2 risk that I usually like to take. Okay, maybe you get filled a little higher too, and that's okay, right? But the point is that you don't have to worry about taking unhealthy risks just for the sake of catching these, because you can still catch these with that exact same approach, and it doesn't need to break your psyche. Okay, so whatever your stock is, and this is why we typically recommend, you know, just looking at a couple stocks at a time and then identifying what you feel is an appropriate risk tolerance for that stock. And to do that, you can just look at some of the moves, some of the bottoms specifically, if you're looking for long trades. Okay, if we look at all these, we can just measure them out really quick. Let me just erase all these. Okay, I see a color change right here. Okay, that's 14 cents. Okay, I'm just going to move these over so you can see the actual candles. I see a color change right here. Okay, and again, I'm not looking at whether or not it sticks. I'm just looking to see what the color change itself consists of. Okay, so in this case, we've got that setup. Okay, I also see a color change right here. That's an easy one. I kind of like that one. All right, and that's I forgot to see how many cents that was. That's 9 cents. Okay, I see a color change right here. So what I'm going to do is I'm just going to go through and map all these out, just like maybe 10 or so, and just kind of see what the average range is on these. Okay, and that'll give you a good sense. Like there's a color change right here. Okay, easy peasy. I'm just going to roughly estimate these. Now that looks, obviously, just looking at these boxes, this looks like a relatively small one. This looks like a relatively big one. So maybe I pass on things that are this size, and maybe I seek things that are closer to this size, but maybe not necessarily just that size. Okay, so if I look at the size of this, I can see it's 16 cents. If I look at the size of this, I can see it's 6 cents. So maybe I look for the 8 to 10 cent range. Maybe 10 cents is a good cutoff. This is 14 cents. That's pretty decent, right? So maybe I don't want to go all the way up to 14 or 16 cents. Maybe I look 10 to 15 cents max. Okay, just kind of landing on a rough number here. This one here is 11 cents, so that would fit. 9 cents would fit. So let's just erase all these drawings. Okay, and I'm just going to draw a box that's 13 cents. Why not? We'll just do a quick 13 center. Okay, and then what I'm going to do is I'm just going to look at all these color changes as the chart progresses. Okay, and I'm just going to look, does this fit? Yes or no? Should I take the trade? Yes or no? Does it win? I don't know yet. Right? I have no way of knowing what's going to be off to the right here in the moment. Okay, so in this case, it wouldn't have happened. Right, so then I look for the next one. The next color change is right here. Okay, does it fit? Yes. Can I take it? Yes. Should I take it? I don't know. What's going to happen afterward? No idea. In this case, you would have had a nice little win. Okay. There's a color change right here as well. It fits. It's beautiful. Same setup, right? Same profit. Then you've got a color change up here. Okay. Does it fit? Sure. I'm talking about when this candle right here was bullish, so it would have been during this. In this case, you would have stopped out. That's okay, because you know that your stop is going to be very small. It's going to be a defined maximum. Okay. Your profits could be as big as you want them to be. Here's another one right here. In this case, you might have stopped out. Maybe you didn't. You should have, because your stop loss should have been the lower of these two candles. But either way, this right here does not fit, so we wouldn't have taken that. This right here. Okay. It doesn't make sense. You would have stopped out for no reason, and it's bigger than your max risk. You've got one here. Very, very tiny risk. These are beautiful when these happen. Same thing here. This one does not fit because the low of this candle is too big. This one here does fit, and it's beautiful. It's nice and small, and you had a nice, beautiful profit potential. Now, you wouldn't have known that. Okay, you would have seen, like, these two would have been relatively equal, and then this would have popped up. Your stop loss would be right here at 452, and then you would have obviously taken profits on that. So you got another one right here as this is forming. Okay. You wouldn't have seen anything off to the right. You would have just had your stop loss right here, and you probably would have stopped out right there if you didn't take profit on this pop. Okay. And that keeps you out of all these red candles. Right. This is kind of the core of this lesson right here, is just learning how to avoid all this shit. You know, because if you flip this upside down, right, you remember the 5 candle rule, 1, 2, 3, 4, 5 or more candles in a row. That's what you're seeing right here. Okay. 1, 2, 3, 4, 5, 6, 7 candles to the bears. So they have lower highs. You can avoid all that garbage. Okay. And the way you do that is just picking things that sort of make sense and sort of give you the inclination that the price should push up, and capping your losses. Okay, that's all it's about, just capping those losses. So in this case, we got one right here. It fits. It would have been a loss. We got one right here. It fits. It would have been a profit. Those two trades cancel each other out with a disproportionate profit because you have a greater than 1-to-1 risk reward. In this case, this is not an engulfing candle. The bullish candle doesn't break over the red candle. It doesn't happen here either between these two. It doesn't happen here either. It happens on this candle right here. So if I were to draw this, and I see that break over there, this trade would be bad because it doesn't fit the risk profile. It breaks down below the box that I've established as a maximum risk. So I can't use the bottom of that candle as a stop loss. That doesn't mean I can't enter it. It just means that I'd have to have my stop loss here at the absolute lowest. All right. And then in this case, you would simply just not let the confirmation bias break your brain. Okay. So in this case, we got another engulf right here. This one fits. Stop loss would have been right here. You would have stopped out. Okay, same thing here. We got a color change right here, because remember, this would have been bullish at some point. It would have been a full body, and it would have broken over the high of this. Stop loss would have been right here. You would have taken a stop loss. Okay, you can't avoid stop losses in the market. And don't stress yourself out trying, because that's where people hurt themselves. This one right here fits. So you would have taken a small loss here, and then you would have had decent profit on this one. Right? You would have locked your profits, and it would have nullified at least one of them, maybe 1.5 of them, right? Then you got another one right here with a defined low, defined risk. It's within your limits. You could trade it. This one here doesn't fit. This one here doesn't fit, right? Because, well, maybe it does. Maybe it doesn't, right? In this case, let's say it did. You would have taken a small loss, okay? Not a color change, not a color change. I'm sorry, color change, yes. So your loss would have been right here, your stop loss. And then your profits would be anywhere along here. It's up here, right? This is 50 minutes now, so I do have to end this episode. I just really want to hone in on this because, again, the strategy itself doesn't matter. The only reason we like strategies is so that we identify when the price is likely to push up in the direction we want it to go. Okay, that's it. That's all it is. Whether or not it goes isn't up to us. We don't control any of that stuff. So why do people try to force things when what's in their brain and what they're saying on their end of the computer and what lines they have drawn on their platform aren't seen by the market, right? Nobody's looking at your terminal and being like, oh, I'm going to put a resistance here and a support here, and we're going to trade the gap. And, you know, Bob from Idaho here wants to see a reversal at 465. So we're going to pull the price back up to 465, and then we're going to see a reversal just to keep Bob happy, right? That's not how that works. That doesn't, you can't, You can't impose your will in the stock market. You have to be humble and understand that you're not really significant in the grand scheme of price movement. No matter who you are, right? Unless you're a market maker with billions of dollars, you're not controlling anything. So rather than trying to hang yourself up on that, look for opportunities like this and just trade them effectively. That's all you have to do. That's your job as a trader. All right. When it comes to things like this, perfect. When it comes to things like this, same thing. Now this risk is a little bit bigger. It's 14 cents, so maybe it violates our rule, maybe it doesn't. But either way, same setup, different end result. Okay, don't let that influence your decisions when it comes to your setups. And if you're someone who struggles and you're frustrated because maybe you take a bunch of small losses, understand that doing it this way also keeps you out of a lot of these big losses. And that's what matters, right? You're going to be in more big wins at this point than you'll be in big losses. And that's what we're trying to go for. You can avoid most of this stuff. And if you're someone who wants to just trade like higher highs and higher lows, you got one right here, right? Here's a lower high. Here's a higher low. Doesn't matter. We get our higher high, higher low, and then we get a bullish engulf right after that right here, okay? Does it go up? Does it go down? Who cares? I don't know. Right? But if that's my strategy and I'm just looking for higher highs and higher lows, and then the bullish engulfs after they're validated, that's all I need to care about, right? Eventually the price will go in the direction that it should go. But the whole point of this is that it doesn't matter what you use for your entry so much. It's how you handle your losses. And when you're in a trade, you want the price to go up. So if the price is here, you can put your stop loss right here. And your target should be up here somewhere, right? Because when the price is, when you're exposed to risk, okay, you want the price to just go. You don't want it to come back. You don't want it to go all the way down here in most cases and then try to find its way back, right? You just want it to go. And if it doesn't, you can always stop out for a super tiny loss and then look for another entry down here when the same pattern emerges. Okay, it's the same end result. You're just getting a better approach on it. Okay, and that doesn't mean try to get things on the way down. It just means that when the strength is there, when you see that confirmation, that's what you can buy. And as long as it has a tight risk, okay? Some days you're going to have just red, and it's okay. It happens. You don't have to be right every trade and make money every day in the market. It's an overall sum of all parts approach, okay? So if you're struggling, at least practice this stuff because it's going to keep you out of trouble a lot. So we're coming up on 53 minutes here, so I'll end this episode right now, but I just wanted to say that I appreciate you all for watching this, and hopefully this episode makes some things click, and every morning when I can, that's all I do on these guys. I just look for those engulfs, and I have the tight stops, and they just go. If they don't go, like this guy, I don't want to be in it, so I just get out. All right, so if you look at this, and this, and this, and this, and this, and then you compare them to something like this, maybe something like this, something like that, and maybe something like that, right? And we got to throw that one in for good measure. What am I going to want to be in more of, right? At the end of the day, I want to be in these guys because they're bigger and they're going in the direction I want them to go. I don't want to be in this right here where it's falling down and I'm losing a lot more money. I don't want to be in that, and I don't want to be in that. It doesn't make sense to. That's not a profitable approach. So why do we do it to ourselves? The answer is simple. It's FOMO. It's not so much that you don't know what you're doing. It's that you're afraid to realize losses. In most cases, you don't want to face the pain of having to realize a loss and make it a thing, right? But when you bought it, you expected the price to go up. You had a defined risk at some point, and we violate that all the time. Our brains just do it for us. So we can identify it, we can overcome it, and we can help others as well. So I really have to end this recording. Thank you all for watching. I appreciate it. You all have a good day, and I'm glad I made that sacrifice to the sun god. So I'll catch you guys next time. Take care and be safe.